Hello and welcome to Simply Tax. It's a new year, a new decade, and on the podcast today, we'll be breaking down the new legislative and other developments in the tax world. In the closing weeks of 2019, the Further Consolidated Appropriations Act 2020 was passed by Congress and signed into law by the President. The act included many tax-related provisions that we've been tracking on the podcast. In particular, it included the extension of a number of tax provisions and tax incentives related to the production of energy and green economy jobs. The Act also included several provisions that mirror those within the Setting Every Community Up for Retirement Act of 2019, also known as the Secure Act, which passed in the House earlier in 2019. Other tax-related provisions in the Act include disaster relief, a retroactive repeal of the Qualified Transportation Fringe Benefit Add-back for tax-exempt organizations for unrelated business taxable income purposes, which we discussed with guest Lauren Denton in episode 70 of the podcast, as well as a repeal of the Cadillac tax on high-cost employer health plans, the 2.3% excise tax on medical devices, and the health insurance industry fee that was scheduled to begin in 2020. And lastly, the Act decreases the tax rate on net investment income of tax-exempt private foundations from 2% to 1.39% and repeals a provision allowing the rate to be reduced to 1% if certain distribution requirements are met. Yep, there's a lot in there, and we haven't even talked about the latest developments in guidance and key things to watch for in 2020. And that's why I'm excited to share with you on the podcast today 3 great conversations I had to help you digest all of these tax developments. First, Ed Karl, the Vice President of Taxation at the AICPA, will share his reaction to the Further Consolidated Appropriations Act, what's in it, and how it came to be. Then, BKD's Dan Smith joins me to break down the changes included in the Act for qualified plans. And then we'll hear from BKD's Lynn Mayabb on considerations for individuals. We'll wrap up our discussion today by hearing more from my conversation with Ed on the latest guidance and other developments that he's keeping an eye on in 2020, along with updates in the activity that he mentioned in our last discussion in episode 66 of the podcast. And with that, here's Ed.
Simply Tax.
I expected extenders to be in that bill, in an appropriations bill, but I didn't expect the other provisions to get in there. The Secure Act, and there was disaster relief and some other things in that bill, which surprised me a little bit. There's quite a bit in there.
Maybe unpacking that a bit, what were some of those ones that were on that kind of made that surprising list?
The surprising list, and number one, the Secure Act, there was a lot of bipartisan interest in it. So it wasn't entirely shocking, but I just thought that to move things along at the end of the year, and I really think it played out about how I thought it would play out, that there would be a CR at the end of September, continuing resolution to fund government at the previous levels at the end of the government's fiscal year, September 30th. That went to just before Thanksgiving, and there was a second CR until the middle of December. That was the questionable one. Would they be able to come to an agreement on appropriation bills, the 12 appropriation bills that they needed to pass, or would we get another CR until January? Or the real question mark that came into all of this, all of the impeachment proceedings, and how would the president feel about signing the appropriation bills? I think he was reasonably pleased with the funding he got for the border wall, which I think helped him personally get over the hump on this one. And so he signed it, but they got in, as I said, the Secure Act, which had a number of retirement provisions in there. There was a bill that we had been supporting for quite a while dealing with changes to the disaster rules. And I think you and I have spoken about that in the past. It was a bill that was sponsored by Congressman Rice from South Carolina. And we are very grateful for his efforts. But the version of the bill that got in was an older version that we had wanted to see changed. There really needed some refinements to the language to get it to work exactly the way it should work. So there was a little bit of concern about the version of the bill that was passed. And so we think it needs to be fixed, frankly.
Where does that kind of leave you? Because it's been a big area of focus, and there are some challenges there. Kind of what's next, kind of given what was included in the enacted legislation.
So that gets into the question of 2020, what happens going forward in a presidential election year. There really is not a lot of opportunity to pass tax legislation. I view what needs to be done with this bill, it's not exactly a technical correction because they enacted what they intended to enact, but the earlier versions that were circulated and we had spoken to people about it needed to be fixed. The language that was written wasn't what they thought it would yield. So it needs to be fixed. And I don't think it would be costly to do it from the perspective of having to understand or pay for provision. So I don't think it would be costly. And I don't think it would be at all controversial. And when we spoke to members of Congress about the changes we thought were necessary, everyone agreed to them. And it's trying to figure out a way to get there. And so that will be a priority of ours over the next several months to see if there's an opportunity to fix it. But in the presidential election year, it's not always easy to get tax legislation.
Again, being that it's an election year and that doesn't generally move forward, what are some of the vehicles or avenues that you could possibly see at this point in 2020 for that sort of a provision to make its way into a bill?
Not a lot. There aren't very many vehicles. I guess one you could say would be technical corrections. There's still interest in technical corrections, but there has to be something in it for the Democrats to get to the point of supporting technical corrections. The one that had bipartisan interest was the retail glitch because it impacted Main Street businesses, and there was Democratic interest in that as well. But that one, unlike the grain glitch, that never found its way into legislation, as well as several other technical corrections. So that possibly could be a vehicle, but I think the one thing that wasn't in this legislation was the Democratic interest in expanding some of the refundable credits, individual credits, low income credits. So if they could get a bill that combined the Democratic interest in the refundable credits with technical corrections, that's something that possibly could move, and I don't think it would be that controversial.
I guess going back to kind of your comment about some of the things that were surprising, and then again, the Secure Act provisions making it in there. Anything along those lines about how things ended up finalized in the final enacted legislation from a pay for perspective and just the overall extender, kicking the can down the road that we've talked about before?
They're temporary, so that limits the cost of them. From a pure policy standpoint, it really doesn't. It's hard to justify having these temporary provisions, some of which were made temporary for reasons that they were intended to fix some kind of a temporary economic situation. For example, maybe some of the energy credits, some of which were made temporary because they were costly. And so you have a mixed bag there from a policy perspective. And the real question is make a decision, get rid of the ones that shouldn't be there or you don't want to incur the cost for, and make the ones that you want to incur the cost for, make them permanent. Having them as temporary provisions doesn't make any sense. But, Damien, we're going to be in a situation in a couple of years where most of the individual provisions in TCJA expire after 12/31/25. So after the election, I think you'll start the presidential election a year from now. You'll start hearing conversations about doing something about those individual provisions. That it will go on for a while, and I would suggest, like it has in the past, it won't be done early. It'll go down to the last minute, and even we saw with some of the Bush tax cuts, including the expired changes to the estate tax rules several years ago, they changed them back after they had already expired in the middle of the year. So I think the conversation will start after the presidential election, but I don't expect them to be done too early. Now, I think part of that conversation will include what happens to the House and Senate in next November. So if the status quo stays, if you still have a split Congress, then I think it'll be hard to make any changes to the individual rules. If you have the Democrats taking over the Senate, I think you'll start to hear a louder voice to make the individual provisions permanent and pay for them, possibly by raising the corporate rate. That remains to be seen as to the results of the election in November.
Harkening back to previous conversations we've had, generally the AICPA likes to advocate for kind of more stable policy and helping taxpayers being able to look out into the future and make decisions. And it sounds like, in a lot of ways, in a period of kind of just uncertainty again in terms of what rates will be and what provisions will be down the road.
We have 12 principles of good tax policy, and we advocate for them, and certainty is one of those principles. But what we don't have in the principles of good tax policy are political reality, and you can't ignore it. You just can't ignore it, and it's part of what goes on in Washington. I'm not saying it from any pejorative sense. It's part of the cost of doing business here, and you're dealing with a diverse Congress and a diverse constituents and diverse interests, and the political realities seem to come first before some of the other principles.
So with that as a backdrop, let's cut through the static of the changes for qualified plans and hear insights on what they mean for businesses and their owners with BKD's Dan Smith.
I'm Dan Smith. I work in qualified retirement plans, mostly 401k plans. I've been doing this since 1991. In fact, July 3rd, I could remember, was my first day.
It's a memorable first day, and a good day, because then you get a day off after there.
Yeah, it was. But I started a small family firm.
Okay.
And worked there for a while. Went to an insurance company where we sold annuities and mutual funds. Mm-hmm. And for the last 15 years, I've been working in a CPA environment. So I've kind of been through the gamut in my world. And like most people in my business, you don't go to college to do the work we do. Mm-hmm. You kind of accidentally fall into it. And some people take to it and some people don't. I did.
You did.
I did.
Yeah, and it's also an interesting time horizon to have too, especially with some of the things that we'll be talking about today, just kind of seeing how that's evolved and changed, and some of the policy and viewpoints with plans have changed in that period of time.
Oh my gosh, yes. Back when I started, no one knew what a 401k plan was. Mm-hmm. Now, it is the most well-known code section at IRS because everyone has heard of Section 401k.
Yeah, that's true. It's a good point.
And so I've kind of been along for the ride all this time. Boy, things have changed a lot. And
maybe just for the listeners that don't have the history, kind of when you started in, I guess 401k was already enacted at that point in time, but it hadn't had a lot of attention yet. And maybe why is it? What's been the kind of the genesis over time there?
It's a really good question. So Ted Benna is the name of the guy who found in this 401k code section this notion of you could set aside income for a later purpose. And originally it was designed for bonus payments. Mm-hmm. So you didn't receive your bonus payment, you would delay receipt and you would delay your taxation. Ted Benna said, we could make this more common than just bonuses. And so that was kind of the genesis of the concept. That was, I want to say it was 1979, 80, something like that. Fast forward to when I started in 1991, 401ks were not very well known. Basically, if there was a retirement plan back then, you had defined benefit plans. My father, who worked at General Motors, had this monthly pension payment he got after he worked for them for 32 years. That was the common way that people were provided for in retirement. 401k came along and said, well, why don't we let employees also have the benefit of tax deferral and to save for their own retirement, to make their own future more secure. And so over time, what happened, companies said, this is a good idea. And so they all started 401ks. 401ks then eventually began to overtake defined benefit plans in popularity, primarily, I think, because they were so much less costly. Defined benefit plans, from an employer perspective, are much more expensive. I won't go into why, but there's a mathematical reason. But over time, people said, well, we should let people save for retirement. People need to retire. So they grew in popularity. Well, eventually, employers saw this as a way to recruit talent. And so now it's become one of those things you just have to offer.
Right.
If you want to compete for talent, you have to offer. And so over time, that motivation has caused provisions to get more generous from an employer's perspective. They allow people in sooner than what we used to. They make more employer contributions than we used to, basically to make their plan more appealing to prospective employees.
So yeah, the market has driven that, so to speak, in a way. And there's been this kind of this build up to these provisions that we just got, this new legislation that was enacted at the end of 2019, the Further Consolidated Appropriations Act, which has provisions of the Secure Act, which was passed, was it May, I think, with that in the House?
Yeah, it was passed in the House in May and then held up in the Senate.
Yeah.
Just political reasons. But it was passed in the House 417-3, which is as close to unanimous just about I think you can get. Basically, there was nothing that people found troublesome about it. The federal government recognizes the need for people to be able to retire with dignity. And so they've seen the 401k as a vehicle for employees to help prepare for their own retirement, because they recognize that Social Security, while it provides a nice benefit to everyone who is a participant, it's not intended to be your only source of income. And there's been a lot of talk about Social Security and future solvency and the like. And so the federal government has a vested interest in people having more resources when it's time for them to stop working. And a lot of what was in this bill, just like bills before it, have been to enhance the ability of employers and employees to grow that type of benefit for employees.
And so when, I guess, have these conversations really started in earnest? Because obviously the legislation in the process, it was, preceded it by a bit. So yeah, what's sort of been the road here to where we are now?
I first heard about a lot of these provisions back in 2014. It was Senator Tom Harkin, the retired senator from Iowa, his legislative director, who happened to be a lawyer in ERISA. This was an important part of Senator Harkin's office. He was talking about, even back then, as polarized as the Congress was, that this would be the one thing that Congress, everyone agreed needed to happen. So I first started tracking it then. Back in 2016, the Senate Finance Committee, Orrin Hatch was the chairman at the time, they passed this version of the bill 26-0 out of committee, but that was the end of it. It didn't do anything beyond that. And then we had similar things that passed in 2018. Both the House and the Senate had competing bills that, had it been passed, would have brought all of these provisions in. But that didn't. In 2019, Senator Richard Neal, who is now chairman of House Ways and Means, this is a significant concern of his. And so I want to say he made this his very first push. They had discussions about this in the House Ways and Means Committee in early February.
Yeah.
He added a few things to this that have since come through that were important to him. And then it passed in May, as you said, but then it was held up in the Senate, and that impasse was not going to be overcome. So actually, we heard that it was possible it might be included in the budget bill, and that's how it turned out.
Yeah, you can have that reason to get things through, and they're able to get that in. And,
right.
So yeah, maybe we can talk about some of these changes, because I know that if anybody's been kind of just following it, that there are some significant ones here, particularly for plans. So what's included here?
Well, there are a lot of changes. It is the most wide sweeping legislation in this area, my business, since 2006. It will, over time, there's a couple of provisions especially that will have a significant impact on the retirement plan landscape. There's a new provision for this thing called a pooled employer plan.
Yeah.
Okay. That's the term the legislation uses. In my business, we would have called those a multiple employer plan. And the idea is you allow more than one employer who are unrelated. This is the significant piece, to come together to create one plan because of the economies of scale that permits.
Okay.
Part of the big complaint a lot of people have is you have so many people in the country who don't have access to a 401k plan. And that's because, frankly, the laws that the IRS, the DOL, Congress have placed require a lot of effort to maintain and comply with. And so the costs are high. Basically, I'm not cheap.
Got it. Yeah.
And so what this allows, this pooled employer plan concept allows more than one employer to come into one plan and have a lot of those employers so you can spread the costs out. Mm-hmm. And so you have this economies of scale. And this actually is connected. President Trump signed an executive order in August 2018 that spoke to this very issue. And currently, chambers of commerce and affiliated organizations are allowed to have these types of plans. But if you are not affiliated in that way, you still have a problem. What the legislation does, it creates this pooled employer plan concept that will allow people to band together and spread out the costs.
Okay.
And over time, that's going to allow a 5-person employer to offer this to his employees without having to pay this exorbitant amount of money. That it makes it so that the plan isn't cost effective.
Yeah. So it's basically kind of opening and allowing this against some of the competition for talent and all that they were talking about by having these benefits. It's allowing some of these, smaller employers, smaller businesses to do it more cost effectively. Am I right?
It's exactly right. And so this legislation basically eliminates the impediment to doing that. And it took this type of action to bring it about. And they wanted to do it for a long time because it's perceived to be the most effective way to allow these small employers a way to set up a plan that they can afford.
And so what has been maybe some of the challenges with that, I guess, conceptually or in the past with getting multiple employers together?
Well, so without trying to go too deep into the weeds.
It's hard, right?
It really is. In short, the fiduciary obligation that exists when an employer sponsors a plan, there was no way to break apart the obligation from multiple parties. Mm-hmm. It's an all or none kind of requirement. So if you had 5 companies and 4 of them were incredibly ethical and one was a bad actor, all 5 would be tainted and all 5 would be subject to penalty.
Yeah.
And so if you just don't trust people that you don't know,
right, because
you're exposed to their bad acts, and the Department of Labor wouldn't allow any provision to move away from that. So this is intended, they've come up with ways to segregate the bad actor. It was so that they could make this concept fly.
That's really what's going to propel this forward and allow it to actually happen.
It is.
Yeah.
It is. But there's also just, once again, the efficiency, because when you have a plan, each plan has its own provisions, and the provisions apply to everyone equally. So what this plan will allow, what this program will allow, is if your plan is simple enough, maybe you have even if you're not a small employer, your costs would be less if you could find a plan that suits what you want to accomplish anyway. Mm-hmm. And so there are a number of ways this will play out over time just to create less expense. And also the other thing that it does, which we haven't really gotten into, is it allows the transference of most of the fiduciary obligation to operating a plan over to a third party.
Okay.
And so that's one of the things that not all employers really understand is the level of their fiduciary obligation. For small plans, the obligation exists. They haven't come under as much legal scrutiny as large plans have. Large plans have been sued because of various, usually expense-related matters, but small plans have not been so affected. But in essence, this also allows it requires that the fiduciary obligation, most of that obligation is transferred to a third party. It will cost something, obviously, but if you're a small employer, you don't have time to keep track of that anyway.
Right.
You don't want to be tied up with all of these rules. If you have 10 employees, you're wearing 14 hats trying to run your company.
Right.
You need someone who can do this for you cost effectively.
Right.
And so with the economies of scale really make this appealing.
Okay. So I guess, what do you expect now? Obviously we're here at the beginning of the year, just actually, even though it's been in the works for a number of years and even was passed in a general form in May in the House, right? Now we've got it. What's the next step? What's the action that you would expect, or that maybe you would, if you were one of these employers, that you would advise them in terms of actions to take on their end?
Well, today, as we're talking, it's a little bit early in the process. The legislation was just signed; it's very fresh, and we've in the industry we've seen it coming, but we've also seen it held up, and so there's this hurry up and wait that we've had to address, and so now we're looking at when these become effective. At this point, there's not a good option that's out there yet.
Okay.
Once again, we're going to have to get some, as typically we get, some regulations and some guidance from Department of Labor and IRS on some of these matters. I expect that we have probably another year before you have, if you will, a product that you could move into.
Okay.
But the good news is there's something coming very soon for a small employer that will allow that business owner to offer a retirement plan to their employees in a way that they will have some expense because there will be some cost involved, but they won't bear it alone. And over time, the cost will come down. Anything that's new takes a little while to develop and the efficiencies grow, but it offers a bright future for a real solution for small employers who don't have the means to offer this now.
That is exciting. But like you said, with anything, it takes some time for the ink to dry, so to speak, and everybody to digest it, really.
Yeah.
So are there other provisions? Obviously, we talked about the big one for the pooled groups here, but what else is in this thing? Like you said, there's just so much.
Well, there is a lot. Well, so I mentioned Congressman Neal. One of the things that he wanted, and he was included, part-time employees now may be allowed into the plan under certain circumstances, and that is long-term part-time employees. So if you've worked more than 500 hours for at least 3 years, then you have to allow those employees to participate by making employee deferral contributions. Okay. Now, when you allow them in, that you don't have to give any other regular employer contributions like you give to your full-time employees.
Okay.
But you have to allow them to make employee contributions. So it's creating access to people who maybe don't want to work full-time, but would like to be able to save for retirement.
Okay.
So he added this provision for these long-term part-time employees. So that's going to apply to all plans. It does not have to apply. There's a 3-year window today, but also after 12/31/19, you could allow them in now.
Okay. So
it's optional now, but it'll be mandatory after this 3-year period.
Okay.
If someone hits this, once again, 500 hours in a 12-month period for 3 consecutive years.
And to do that would require a change to your plan, right? To allow them in, or what happens there?
It's a really good question, and it's kind of bigger than this particular.
Okay.
So one of the things that jargon alert. One of the things that they did was they created this thing called the remedial amendment period.
Okay.
And the remedial amendment period basically is a period of time where you're allowed to operate the plan under these provisions without having written them into your formal plan document. And it's common to do that when you have significant changes because it would create a lot of hardship to try to have to do everything right away when everyone knows this is coming. Everyone knows this is what it's going to be like. And so they allow you to operate it as if you have already made those changes. You have to make them eventually.
Right.
In fact, to your question, for non-governmental and non-union type plans, you have until 2022 to amend these plans. Now, for a lot of what we do are called pre-approved plans, more jargon here, pre-approved plans, which are a specific kind of plan. For those pre-approved plans, we have a periodic restatement coming, period. So we're going to have to restate, which means basically give an entire new document in 2022 anyway.
Okay.
So
that kind of aligns. Yeah.
Well, it kind of does. Now, these changes will not be included in that because these changes were approved a year and a half ago, or have been in the process for the last year and a half. But I expect that there will be incorporated as a part of this process where we will have these required amendments built into that process. I don't know that. I'm kind of speculating.
Right. But kind of at least in terms of you're already kind of tinkering with it, so it would make sense to kind of layer this in. Yeah.
Well, and this legislation says you have to make these changes by then anyway, so it's going to become a natural. But they basically put in almost a 3-year window to do it.
Okay.
So yes, you do have to make a change, but like in this case, it doesn't have to be amended right now because of this remedial amendment period.
Very interesting. And if you were considering maybe, like you said, early adoption, so to speak, of even the part-time employee rule, I mean, there obviously there's a cost to any sort, or there can be, I should say, costs to those sorts of changes. Do you anticipate that there'll be some modeling, or do you, just based on your experience, or do you think that employers will wait, or they'll just do it and kind of go from there? What would you expect to kind of see the response to be in the market?
Well, the thing about it is they made it so that this addition of these part-time employees does not affect your other plan operation. So we're typically, at the end of the year, we do compliance testing. These people are all going to be excluded from that.
Okay.
So that really should eliminate the need for any modeling per se.
Okay.
Typically, modeling has to do with how much it's going to cost me if I make this change.
Right.
In this case, the only cost that might come into play is if the plan were to pay some type of per participant fee. That would be the only thing that I would anticipate would be different.
Yeah, because like I said, you're not, all the other things in the plan don't have to apply.
Exactly.
So that definitely makes it a little bit easier to go ahead and start implementing that, I suppose. Yeah.
Yes.
Okay. So what are some of the other key provisions here that were included?
Well, there is another nice addition. There has been a tax credit when you set up a new plan. The tax credit was up to $500 per year for the first 3 years. Okay.
All right.
So under the new law, the new tax credit is whichever is greater, $500 or $250 per non-highly compensated employee covered by the plan. So for simplicity, a non-highly compensated employee is either a non-owner or someone who earns less than $130,000 a year.
Okay.
So $250 per person per year. So instead of $500, it can be as much as $5,000 per year.
Yeah.
Which is a big difference.
Yeah, it is.
So that would defray a lot of cost for a small employer because there is some startup cost. But especially for a small employer, that probably should come to a long way towards covering their expenses.
Okay. All right. And that, definitely makes it a lot easier to take on, and again, help the changes to succeed. If ultimately the goal here is, like you were saying, to kind of drive some of these changes in policy.
Yeah.
That'll be interesting to see how that kind of comes out then.
Yeah. And I actually, when the first tax credit came out, I didn't see it as a great incentive. $500 a year doesn't cover a lot.
Yeah.
$5,000 covers a lot.
Yeah. Okay.
So that's an important change, I think. We'll see the impact it has because the rest of the economics still have to make sense.
To put the plan in place.
To put them, because
this
we're talking about a long-term commitment. There is some effort to operate the thing every year. So cost is a part of it, and that eliminates the startup cost, I would think.
Yeah, because there is a lot to weigh in these things, especially if you haven't done them before, and that helps with at least the cost considerations, I guess, I suppose.
So one of the other things that applies to some plans, which I know I have a lot of clients that are going to celebrate, in the 401k plan, as I said earlier, we have these compliance tests we do and the compliance tests, we test employee deferral contributions for the entire plan. A lot of employers have a safe harbor provision, which basically the safe harbor provision says, as an employer, I commit to make a certain amount of contribution to my employees. And for that commitment, we pass all of this compliance testing.
Okay.
Yeah. Well, we've always had to provide a notice each year to all the employees to let them know that they were going to get this benefit. That's been around since this concept was first introduced many years ago. Well, there are two versions of this. You can either do a version where the employer does a matching contribution, or you can do one where they just do a flat amount, and the matching contribution only is contributed to those people who contribute, make employee contributions. There's another employer contribution which goes to everyone without regard to their employee contributions. Well, the second one, the one that everybody gets, the notice requirement has been eliminated each year.
Okay.
So that's one thing that's changing that they're going to be happy about, because my clients all tell me that people don't read the notices anyway.
Right.
We send them out every year with, there's a number of them we do, and it's just something that you're not allowed. So they're going to be happy to not have to deal with that.
Yeah.
The match version, you still have to send out, because the match version is dependent on, as an employee, you are contributing to get it.
Yeah.
Or the other one, you're going to get it regardless.
And so it is kind of you get back to the employer that's saying, come on, this is meaningless, but it's the hoop we have to jump through. So that is a nice administrative burden to kind of reduce there.
No, it really is. And so that was one of the things we were all pretty glad to see, because for us there's an element of nuisance.
Yeah.
You have to do it, you do it, but we'll be glad to not have to, because it didn't really add a lot of value, we didn't think.
Yeah.
And that's kind of the point, isn't
Right.
it? We want to add value with the efforts we provide to our clients.
Yeah. In a way, it also, you get so much anymore emails, letters, all that stuff, right? That is just more noise. So it's at least, kind of cutting down on that, so it doesn't distract from the important notifications that you do want to hear and the value add that you are receiving.
Yeah, and it also comes down to, it's less that our clients have to deal with.
Yeah, yeah.
Which I don't have any clients that aren't busy, just like you don't.
I don't know them.
Yeah.
If you find one, that would be news to me.
Exactly. And so as much as we can take a burden away from them, that's what we always try to do.
Right.
This is one of those times where we actually can make that happen.
Yeah.
So
very nice.
We're happy about that.
Yeah.
As I said, the government is interested in employees having more money set aside for retirement. There is this concept called auto enrollment, and there's kind of a cousin called auto escalation. Auto enrollment is where you automatically put people into a plan at some default contribution rate, unless the employee says don't. Okay. Well, historically, then from there you can decide to increase some percentage a year. Maybe an employee starts at 6, you increase them 1% per year. You coincide that increase with their salary adjustment, and so they get a 3% wage adjustment. 1% more goes into their 401k plan. They don't really miss it. They still get a 2% raise. They get the tax benefit of the 1% deferral, and now they're putting in 7%.
Yeah.
Instead of 6.
Yeah.
Well, historically, we've had to cap that escalation to 10%. They've increased that to 15. And 15 seems to be what the literature is saying is kind of the ideal rate, whatever that means. I can't speak to that, obviously. But they think that if you can get 15%, some people say that's a really good place to be.
Yeah.
Historically, people don't put that much in. Like I said, I'm just reading the studies. I don't know. There seems to be a consensus kind of evolving there.
Yeah.
But that's a change that they've implemented. Because prior to this, you couldn't raise it above 10. So it's once again kind of increasing the capacity for people to save for themselves.
And doing it in a way that is kind of notching away at it up to a little bit higher bar. Okay.
Exactly. Here is something that I think is going to be incredibly beneficial, especially for tax preparers. They're going to allow, starting after tax years beginning after December 31, 2019, they're going to allow employers to adopt plans after the end of the calendar year. So before now, I set some new plans up in December. We had to have all the paperwork signed by December 31st. Next year, for 2020, the year we're currently in, that's going to be their tax filing deadline, including extensions. They can still sign it, and it can be retroactively effective.
Yeah, that is a very nice change, because I know sometimes that those conversations come up. You realize it was a good year, or maybe you, for whatever reason, you decide that you're going to proceed with the plan. Get that flexibility to actually do it after the year end is huge.
This is something we've asked for many years, for the obvious reasons.
Right.
Because you may not know until well after.
Yeah.
And so now we're going to have that flexibility. So that's going to be, I think, a lot of people will take advantage of it that might have done the plan sooner. But there will be others who now can do it that couldn't before. So I think that's an important change.
Yeah. And is that one that's a line in the sand one as well? It's 12/31/19, right? Yeah, you said for 2020, then we'll be able to look at that. Yeah,
Right,
that's very good news, and it's also, like you said, for the you're getting around to tax time, helping as a tax practitioner and say, well, here, this is additional thing to consider before filing the return. Do we want to do this? Yeah.
Yeah. No, I had a lot of clients who I heard from and said they'd like to know about different plan design options.
Yeah.
And I thought this must have been a pretty good year for a lot of people because of the calls I was getting for plan design discussions.
Yeah.
That seems to be the consensus most places anyway. It was 2019 economically was a pretty good year. This will just allow more flexibility. So I think that's an important change.
That's good news.
Another one of something that we've asked for a long time is, one of the things that's hard for people to tell is how much do I need?
Yeah. I think that's a huge question, right? Yeah.
And how do I know when I have enough? How can I tell? Is, $50,000 enough? Do I need 100,000? Well, even if you knew how much your balance was, how long would it last you?
Great question.
Exactly.
Yeah.
And so there's been a lot of discussion about how do we determine some calculation to give people an idea of what they can do. And so one of the things they passed, they have this lifetime income illustration that you're going to start seeing on participant statements. If your account balance is $50,000 and you're 60 years old, there will be a calculation that will tell you this will allow you to receive $350 a month for the rest of your life. I don't know if that's true. I'm just saying,
right,
for example,
hypothetically.
there's an illustration of what your current balance and your current age over your life expectancy would allow you to take out every month.
Yeah.
It'll give you some type of realistic estimate.
Yeah, to translate that into, what, because right, everybody thinks in retirement, you're thinking about your monthly expenses. You're not thinking about, the annual and converting this balance into what it's going to mean, on the month-to-month basis or even the annual basis, because you can't necessarily do that, correlate those two things without something to translate it. Yeah.
And it's especially valuable to people who just don't have a lot of resources. Because if you have a lot of resources, if you've been very successful in your career and you have a nice nest egg, you can hire somebody to do that for you.
Right.
If you don't, then you're at the mercy of some internet calculator.
Right.
Or some author in a book who says, do it this way. This is going to be better than what we've had. We've discussed this for 15 years that I know of, different methods. The problem has always come down to how do you calculate it?
Yeah.
And
assumptions and all that, right? Yeah.
Exactly.
Yeah.
So what's going to happen is the Department of Labor has been tasked with coming up with a formula. And it will be effective 12 months after they release their guidance. How to do the math, it'll start showing up, or it's supposed to start showing up on participant statements.
Okay.
So to me, that's another nice enhancement.
Certainly
It's always the problem. How do you calculate? And so I think that's going to be a nice addition.
Sounds like it will, again, to help people understand, maybe even incentivize them more. Say, oh, wait, this is going to be a gap, or whichever way it comes out, at least you have a sense, right?
Yeah. Well, and when we discuss with participants, because we have advisory people on the wealth advisory side who will have these discussions with employees. And they can walk through this with people. Not everyone, though, has access to that.
Right.
And so this will be something, and even with the ones that we do help, we can point to this and say, look how you've improved it. Remember what it was last year? Now look at what it is this year. And so they can see it building. Yeah. And to your comment, it will help them feel like they're making a difference, which in the end, we all want to do.
There's always this deal with it's sort of like saving for retirement is a habit, right? And you kind of have to have that. The challenge with something like retirement is it's such delayed gratification. Well, then this at least helps you to maybe translate it a little bit sooner into like you said, seeing the dent that you're making. Yeah,
well, in some way it makes it look a little more tangible because prior to that it's an account balance and it's still just an estimate, but it's an illustration of what it's worth. Because if your illustration says you can get $3,000 a month, then you have a sense of, well, okay, that's what I can reasonably think is what I can use as my estimate. If it says $300 a month, it's a whole different mindset you have.
Right. Well, that's a good change.
Yeah. So, and there were some other technical changes. One of the things I thought was interesting is they're going to allow penalty-free withdrawals for birth expenses for the birth of a child or adoption. I read somewhere recently where somebody's guidance said perhaps employers will think about adding this as a reason to take money out of a plan. Because currently in a 401k plan, we're pretty restricted on the ways you can take money out. and this probably doesn't qualify. From an IRA, that'll be a nice change, because an IRA, you still have to pay the income tax on it, but there's a 10% penalty that you would forego if you're not at least 59.5. So once again, it's a way to help people with expenses they need help with. And so I thought that was an interesting addition. There's also some things in there that have to do with insurance products and portability of a lifetime income. As I said, my father, who got the pension plan, had this monthly payment. Retirement plans currently don't have a good solution for that. So somebody works their whole life, they've got a $300,000 balance, they've saved all. Here's your money. What are you going to do with it? Well, if they don't have someone to ask, that creates a challenge, because you spent your whole life accumulating. What are you going to do now?
It's time to you in one moment,
So there's some benefit to that, and there, like I said, some technical changes that they implemented. Just one last little thing. They also created a provision that you can adopt a safe harbor plan. I talked about that earlier. You can adopt a safe harbor plan mid-year instead of, historically, you've always had to do it prior to the beginning of the plan year. So now you can do it mid-year. Now, you remember I talked about the two kinds of safe harbor. There's the matching version and the straight percentage version. You can only implement the straight percentage version, and it has to be 4%, but you can do it mid-year if you decide, where that's never been allowed before. So once again, a little flexibility that didn't exist. All of this is designed to enhance the value of the program, to bring more people in, to help more people save, to help more people be prepared when the time comes when they stop working.
No, again, all kind of in line with, it seems like, the overall policy, like you were saying here, to allow more into the system and get people there. And it sounds like this is definitely a step in that direction to accomplish that.
Well, that's why it was so popular coming out of Congress. There's very little to hold it back. Those are all positive. And as I mentioned earlier too, when we were talking, there's also some more legislation maybe coming at some point down the road. There's other discussions that are going on, but right now this is what we have. Like you said, it's a great addition to our tool belt, if you will.
No, it absolutely is, and kind of getting people, again, helping people out. So it's a positive thing, and also, going back to the employers, a lot of small businesses, middle-sized businesses that I've talked to, work with. There is sort of, in a lot of industries, this sort of talent shortage and so forth. And, you really have these wars for talent, and to be able to compete with other employers is huge. And again, this kind of seems like a way, kind of circling back to the first, kind of the big change, right? To allow people to do that. Well, even just some of the flexibility, right? Because it allows more people to perhaps consider it at different times and in different ways that fits their situation.
No, it's anytime you get involved with the government, from the IRS, Department of Labor, you can't do that carelessly. Because, as I tell people a lot, it's really important that you operate your plan, you know what you're doing, and you operate it correctly, because mistakes are expensive. You're basically letting them match to money.
They really are.
And nobody likes to do that.
No.
And nobody likes to tell you. I don't want to tell you that we've discovered this problem, and so it scares a lot of people off. And so a lot of these provisions, like I said, when we talked about the pooled employer plan, a lot of those kind of things that should alleviate a lot of this. It'll also eliminate a lot of those errors.
You get additional flexibility.
Because they're going to delegate that task maybe to somebody like me, who's going to make sure we do it right. And so a lot of the errors that the employer might make because he's in a hurry, he might overlook something and not realize he overlooked it. That's kind of what you get when you delegate that task.
Well, not to mention too that you're doing it once a year or whatever, right?
Exactly.
And you're just not doing it as frequently, so you're gonna have to remember. So more prone to error for sure.
Exactly.
That's definitely those will be some good changes there. So speaking of that, because I know that's an area that, again, not necessarily related to this, but that obviously you've helped with a lot of these plans, a lot of plans throughout your career. Are there any best practices or tips that maybe they ultimately will be impacted by these changes?
There's a lot of things.
I'm sure there are. I know. Like, kind of like your top things to watch for or something. I don't know.
Every year you would think this wouldn't be the case, but the biggest, most common error that happens in retirement plans is somebody uses the wrong compensation. You would think, well, we just use W-2, right? Well, not necessarily. The plan documents all have some definition. It's a legal definition, and you have to follow it. And the IRS says every year it's always in their top 2 or 3 errors, everything they audit, is you use the wrong compensation. Now, that can be a minor problem. It could be a major problem.
That is one thing that is universally true from my perspective, is knowing that you don't want to get on the wrong side of the IRS and the DOL on those sorts of things, because you're right, can be very, very costly.
And the other thing we talked about recently is smaller employers typically don't have professional human resources people.
Right.
So the employer's got to do all that himself, whereas a larger employer has a department and their job is to know this stuff. And so for small employers, make sure you rely on your professionals to walk you through these things. And don't be upset if they tell you something you don't like, because sometimes we have bad news to bring.
Yeah.
We wouldn't choose it. We're messenger.
Right. But at the end of the day, it's making sure that the news isn't even worse.
Right.
By there being some sort of an embedded problem, a definitional problem, and so forth. So I guess it speaks to why you've got to get the experts involved, like yourself, to make sure that you're really adhering to the plan, that you're looking out for changes, things that have come down the pipeline, and are just doing it correctly.
Yeah, I have a new client, and I was looking at their plan document, and it was a very inexpensive plan document, and it was a very abbreviated, as in 6 pages.
Oh, wow.
Mine typically will run between 50 and 70 pages. This one was 6.
Yeah.
There was one box checked wrong.
Oh, man.
When I talked to the advisor, I said, I got bad news for you. And he's like, so he called the document provider, and they said, well, people know that's not true. No, that's not the case. That's not the case. The box that you checked meant, in this particular case, this employer who thought she was the only participant in this plan had accidentally included her part-time employee all along. So now she got to go back for 3 years and make a contribution for this employee.
Right.
And it's not going to be that cheap.
Yeah.
He's part-time, but it's an example of one box is all it takes.
Right. You really got to mind the details and make sure that you're implementing these things correctly.
Because in the end, the money she saved in the document, it's going to cost her a lot more now.
Sometimes you get the right advice on the front end. Like you said, it's not always cheap, but in long run, it's actually cheaper than getting it wrong, for sure.
Yeah. It's just, there's just so many things that impact how they work.
There absolutely are. And well, I don't know, at some point I feel like, I would love to kind of go down that road even a little further with you. Like you said, get into the weeds a little bit on some of those things, because I think there are, I kind of see 2 camps. There's those that kind of bury the head because I think, again, just the intimidation factor. And then those that are, because they're so intimidated by what can happen when it goes wrong, that they're, they just kind of shy away from it almost and kind of go the opposite extreme. So I don't know. Those are tricky things, no doubt.
Yeah, for better, for worse, it's kind of why I like this business.
Yeah.
It's complicated, but there's a right answer almost always.
Yeah.
I like that part.
Yeah, and again, at the end of the day, it brings value. Sometimes maybe isn't the answer you like, but it's bringing value because it's watching out for the things that can happen if you do ultimately get it wrong.
Yeah, unfortunately, most people are always glad to find out.
Yeah, no skeletons in the closet here, right?
Right.
So I guess, kind of bringing the thing full circle, talking about some of these changes. What are some thoughts that you'd maybe kind of leave everyone with as it relates to really these changes and kind of the going forward?
I'm a believer in the 401k plan concept. I'm certainly not unbiased about it. I've been in this business for a long time, but just looking at my own experience in it, had I not had a plan, I wouldn't be at the point in my own preparation for that day. So I believe in the 401k plan, but you have to make sure the advice you're getting is sound. There are a lot of places that will offer you something inexpensive, and it sounds really good up front, but most people don't know what questions to ask.
Right.
And you need to have someone that you can count on. And in my business, that really needs to be professional. You don't want someone who has a couple of clients.
Not an area to dabble in, so to speak, right?
Yeah, because it's too complicated. I mean, the lawyers that I've talked to in the past have all said when they were in law school, Their professor said, if you're not going to focus on ERISA, don't touch it.
Some good advice, because it's definitely, and I think one of those tricky things too, that and why, when we had all these changes coming about here, I reached out to you because I know you've seen over a career these changes, because you kind of have to live in it for years to just have the war stories to know what to look for, the instinct of what to look for, and know what's going to happen to get there. And it's not something you can just, like you said, just deal with occasionally and pick up that level of expertise.
No, that's true. And that's, I guess, one of the things that I appreciate about that is I see a lot of things coming before they get here. Mm-hmm. And I appreciate the ability to be able to advise my clients, you need to do it this way, because if you don't, here's your risk. Mm-hmm. Mm-hmm. Or here's what's going to happen if you don't change.
Right.
And I've always found that pretty rewarding personally, but my clients appreciate it too.
Right. Yeah. Well, I appreciate, again, your insight, your perspective, for kind of walking us through these changes, because it's overwhelming, I will admit, to hear some of these changes and not actually kind of have them in context. And you've done a fantastic job of really putting them into context. So.
Well, no, I appreciate that you invited me to come on.
Yeah.
And one of these days, I'm going to hear you play piano. I love a good jazz tune.
All right, let's next tune in to hear how the changes included in this year in tax legislation impact individuals and their financial and estate plans. Here's BKD's Lynn Mayabb, starting with her response to a question I like to ask advisors following fast-moving developments in the tax world. And that's, what's been your experience with tackling these changes so far?
And that's a really good question, because it didn't pass until December 19th, I think it was. And then with the holidays and things, I believe it got overlooked a little bit. But for us, immediately there are a lot of articles and information out there on the different changes. And so for us, we were actually looking at, okay, which clients will it immediately impact that we need to make sure we get a hold of first? And then what's our plan of action for the other clients that we know in the first 6 months of the year, they will also be impacted? And what's the course of action they need to take that's probably their highest priority to make sure that this change in law doesn't come back to either cost them additional taxes or maybe make their estate plan not work the way they thought it was going to work.
Yeah, so maybe almost kind of like a triage type of approach.
Exactly. Because they're being so close to the first of the year, when a lot of people go ahead and start taking money out of their portfolios, this does impact that and may change their mind about where they take their funds. And so it was really important for us to get a hold of those clients and see if their plans would change because of this change in law.
Time is of the essence when those sorts of decisions are being made and the landscapes change. So yeah, maybe we can start to kind of dig into that a little bit more and unpack them. I know there were a lot of changes, but maybe kind of taking that same triage approach and talking about them, what were some of those key changes?
I think there's probably two that required the most attention up front. One that was the most simple was pushing back the required minimum distribution age for IRAs and retirement accounts to age 72 from 70 and a half. So that immediately impacted those individuals that would turn 70 and a half in 2020. And so anybody that was born July 1st of 19 would be the first person that would turn 70 and a half the 1st of January this year. So that was one of the immediate changes. And then the other biggest change, I think, that is going to have people making a lot of changes probably to their estate plans was changing the stretch provision for IRAs. And so what that did was probably undo a lot of people's planning for the people that they had named as beneficiaries or the trusts that they had named as beneficiaries on their IRAs because of the new rule. And so getting with our clients and making sure that they address those issues is going to be really important to us.
There's been a lot of conversation about the stretch IRA and the planning and kind of the death to the stretch and so forth. Could you talk a little bit about kind of what the regime was before and obviously now how it's changed, and then sort of what does that mean for your plan and your financial and estate plan?
So the first thing is anybody that was already age 70 and a half before December 31st, they have no changes. And so they need to realize that whatever rules they're operating under do not change. The changes to the stretch provision, again, apply to anybody that passes away in 2020. So if somebody passed away in 2019, they're going to operate under the same rules for inherited IRAs. If somebody passes away in 2020, now their beneficiaries have new rules to follow. If it's a spouse, they operate like nothing happened for the most part. They can still stretch out the IRA over their own lifetime. If they have a terminally ill beneficiary named, they also get the benefit of continuing to have a stretch and be able to take those payments over their remaining lifetime. If they have their minor children named as beneficiaries, there's some new rules. So they fall under a special provision where their 10-year clock of having to get the money out of that inherited IRA does not start until they reach age of majority. So they don't have a full stretch, but they have a little more time. And if they have named a beneficiary that is less than 10 years younger than them, they can also continue to take that out over their own lifetime. So those are the 4 exceptions to the new stretch provision rules. Anybody else who receives an inherited IRA has to have all of the funds out by year 10 after the person passed away. And so what that does is could cause some significant tax implications for those inheriting IRAs. It can also impact if a trust was named as the beneficiary. Typically, it's 2 types of trust, a accumulation trust or a conduit trust. It can make the language in those trusts almost moot and make the beneficiaries where they cannot access any funds until year 10. And so that's one of the major changes that we'll need to be working with our clients and making sure that they are reviewing their beneficiaries, visiting with their estate planning attorney, because there's likely going to be changes to their trust documents that would impact then who they name as the beneficiary on their IRAs.
Yeah, which is probably a good conversation to have on an ongoing and regular basis anyway, I guess is kind of the best practice, right?
Correct. People should check who their beneficiaries are on IRAs, life insurance, 401k, or other retirement plans, at least on an annual basis, or if they have any change in their life, if they get married, divorced, have a child, etc. And so this is just, when they believe they have the right beneficiary named, now they may not.
With these changes, it kind of really tees up that importance. So what's your thought on how to approach it, especially if there's going to be maybe changes need to be made to trust documents and so forth that, obviously everybody, even the professionals, are digesting all of this. What would you kind of recommend as an approach in terms of figuring out what that action is and the timeline for taking those action steps?
I don't think it's a panic period, but it should be a top priority to get that done, because if they check their beneficiaries and a spouse is named as their primary beneficiary, that's fine. But more than likely, they have contingent beneficiaries named, which probably fall into one of those other classes that would not be able to stretch that IRA. And so in any case, I do believe that most people will need to make changes to their contingent beneficiaries. And if they have a trust named or grandchildren named as a primary beneficiary, they definitely need to get that changed as soon as they can. And so that's going to require them to, one, go visit an attorney to get those trust documents reviewed, or if they have somebody named as a primary beneficiary that would no longer be able to stretch that payment out, they need to look at, well, what could I do to minimize either the tax impact on those beneficiaries, or should I be changing the beneficiaries? Do I need to change up my charitable gifting maybe and change where that's coming out of? And the other thing I think to consider is really what's the size of the IRA. I forgot to mention that earlier, but for somebody that's spending their IRA and spending it, may spend it down, may end up with less than, $400,000 or $500,000 when they pass away. They are not going to have nearly the issue as somebody that has $1 million or $2 million IRA or 401k account. So the size of IRA does matter as far as how quickly should somebody do something related to their beneficiaries, or do they really need to do something?
Kind of a follow-up question to that is, obviously there's a distinction between sort of the traditional IRA and the Roth IRA. How do these changes, I guess, impact the type of account that you have?
Good question. Roth IRAs don't have required minimum distributions while somebody is living. They will still fall under the same rules for an inherited Roth, but because the tax implications are not nearly as severe, if there are any at all, depending on how long an IRA was held. There's a couple little provisions in there, but for those that are going to inherit a Roth IRA, they likely don't need to do anything right now, unless I'll put a caveat out there. Maybe it makes more sense for somebody else to inherit the Roth and change the beneficiary on the traditional IRA. So there may be some changing of who's getting which assets based on tax bracket of the person who's going to inherit and who that person may be.
I see. So basically, it really kind of needs to be holistic, right? And kind of thinking about the overall picture and doing the math on really what is the most tax efficient way to transfer these assets.
Yes, that's right. Because a lot of people in their estate planning really were looking at, okay, who can I give this IRA to that can stretch it for the longest? So they may have their grandchildren named. They may have the youngest of their children named as the beneficiary and be giving other assets to the older children or their spouse even. And so now they need to look at it and say on a flow chart, okay, here's my assets. Where can they go and where should they go? And what's the tax implications of that person receiving these funds?
Which is a little bit challenging too. And I was actually having a conversation with someone just yesterday about just some of the uncertainty and rate uncertainty and so forth. When you start to map that up, because you kind of have to have some assumptions, and that's probably the inherent thing that's both interesting probably to you as a financial planner, but also challenging because you're kind of having to make some assumptions there.
Right. And we're operating under tax rules that we believe are in effect until 2025. So do you only plan for a 5-year period based on, what tax bracket somebody might be in? Because you have to, make an assumption of where tax brackets might go after that period of time.
Yeah.
Because that does impact it. And also the age of the IRA owner or the retirement account owner needs to be taken into account, because those that are younger will have more flexibility typically to maybe put some steps in place that older account holders may not have, as far as should they stop contributing to a traditional IRA and contribute to a Roth IRA, because we know that in the end, the person receiving the Roth IRA should be in a better position from a tax standpoint. Should they do some conversions of their current IRA? What is their tax bracket compared to who might inherit that? So should they be doing some conversions? So there's a lot that goes into the analysis. And really, I think almost each individual is going to have to be looked at separately, because tax bracket plays into it, age plays into it, size of the accounts, number of beneficiaries has an effect on it, because somebody with $1 million IRA with 5 beneficiaries, it's probably not that big of a problem versus a $1 million IRA with 1 beneficiary.
So it's like with anything, I feel like, and this is sort of the recurring theme, there's really no one size fits all, right? Which is the hard soundbite sometimes to offer, because you can't necessarily just say, you should do this because of this change. It really depends on the facts and circumstances of the person, their personal situation, their plans, what they assume will happen out into the future. So maybe it all just comes down to, it depends on you.
I think that's exactly right. It really depends on the individual and also what their goals are, because will their goals change any because of these new rules? They might. And there's not a one size fits all for, every person that is in retirement, or every person who's age 65. They're not all the same, and we have to look at that on an individual basis. Even the simple change of pushing the required minimum distribution age back to 72, that is probably going to only impact maybe 20% of the IRA and retirement account holders because many people are already taking money out for living expenses before they reach 70 and a half. So even something like that is not, applicable to everybody.
So maybe to that end, because I feel like whenever there's change, and perhaps particularly when it deals with retirement and those sorts of accounts and planning and estate planning related to them, that there's maybe some misunderstandings, some misconceptions that kind of creep in there. Are you hearing anything, at this stage of the game as it relates to some of these changes? Or are there maybe some things to kind of watch out for of information out there?
I think one thing that is interesting that I actually heard today from some estate planning attorneys was that even in the legal world, there's not an agreement on what exactly should be happening with an accumulation or a conduit trust. So that I thought was very interesting. And I think there's probably going to have to be more guidance that comes out on that. A couple of themes come to mind, which is most likely everybody needs to do something, even if it's just check their beneficiaries and confirm them. But beyond that, there could be a lot of different solutions for the possible issue of not being able to stretch that IRA. So again, we have to look at every individual situation and see what solution might work best.
And you've also touched on a topic that's near and dear to my heart. That is the collaborative approach, that you can't do it in the vacuum, because you're talking about the financial advisor, you're talking about the estate planning attorney, you're talking about the tax advisor, in all of these different pieces kind of moving in conjunction, not doing one in isolation, and really kind of bringing in the sort of a board of advisors to kind of help with navigating this. That's kind of seems like the best approach, right?
It really is. And there's usually going to be somebody on that team that may have a little more information on the client than the other team members, but they may not have the expertise to, maybe the CPA does have more information than the attorney, but the attorney's the one that may have to change the trust document. So you really need to be working hand in hand with other professionals to make sure that what you're trying to accomplish for the client is being done the proper way and is going to be, in their best interest and help them continue to meet their goals that they had established.
Absolutely. That's great advice. Are there any other areas or aspects that kind of come to mind that you wanted to dig in on?
Yeah, there's a few other things that one thing that didn't change that I think slipped through a little bit that people maybe didn't pick up on is the ability to continue to do qualified charitable gifts once you're age 70 and a half. So even though the required minimum distribution age has been pushed back to 72, individuals can still give up to $100,000 out of their IRA to charity once they reach 70 and a half. And that can be a really good tool to either, one, first of all, meet their charitable desires, but two, maybe reduce down the amount of that IRA a little bit so they can lessen the tax implications on whoever might inherit it. And so that is still available. And so for those that are charitably inclined that were using that has not changed. They can continue to use that even though they don't have a required minimum distribution out of their IRA. So I think that's key. A couple of other things that changed: if someone has earned income or still working, they can now continue to contribute to an IRA, a traditional IRA, and they weren't able to do that before. So once they reach 70 and a half, they can continue to contribute as long as they have any type of earned income. The kiddie tax, kiddie as in children, is going back to the parent rate again. So paying at whatever marginal rate the parents are at. So that is a change from previous tax laws, which may be beneficial for some younger children. Another thing that was included in there, which is you can now take out $5,000 penalty free from an IRA for a birth or adoption of a child. Just a simple thing like that, but that's a benefit, I think, to many people.
Yeah, it absolutely is kind of enhancing and giving additional flexibility.
Right. And another thing that was a change that may help some students, because we see a lot out there on student loan debt and default rates, are now 529 or college savings accounts. You can use up to $10,000 to repay student loans. So if there's extra money in the college savings account that maybe a grandparent set up for a child, they can use 10,000 of that to repay their student loans. And they can also use money in that college savings account if they're doing any type of apprenticeship for one of the trades. So that has also been something that's been added that could be very beneficial because you couldn't use those funds to pay for that before.
Right. And obviously some of these changes are retroactive. So they're kind of going back as part of the kind of this extenders notion of going back like the kiddie tax and doing it retroactively. So there's an opportunity here to maybe even go back and look at last year and see if there's a chance to change the return.
Right. And there were some extenders in there that the limit on healthcare deductions. So you only have to exceed 7.5% of your adjusted gross income. That was extended again. So there are some things in there that could be beneficial to some individuals when they're filing their taxes. And, I think the one thing that people are looking at that they say could be maybe detrimental in the future is just taking away that stretch provision for individuals other than those few excluded classes.
If you were going to kind of bring it full circle, you kind of had one kind of takeaway message for individuals and families, and as they're looking and revisiting their plans, what would you say?
One thing I would say is really talking to the client, because some clients, when they pass away, they don't care who pays the taxes. So that's probably the first question is, besides checking your beneficiary, is, does this impact you? Does this give you any heartburn if your children inherit this and they're going to pay taxes at some point during the 10 years after you die? Because many people will say, I don't really care. So they may not want to do anything. So I think that's one thing to think about. But for most people, it's going to be revisit their goals, look at their beneficiaries, see what steps they could take if they need to either lessen that tax burden, to make some changes now that could possibly lessen it, because again, we don't know what the tax rates might be after 2025. And so it's really sitting down and just having that conversation to say, here's where you're at right now. Here's what's going to happen if you make no changes. And here's a couple of possibilities of things that could be done to remedy the concerns you have.
No, that's a good approach, kind of walking it through and run the scenarios. Got to do the math, right?
Right.
Let's wrap things up today by hearing more of the great and always helpful insights from Ed Karl. About to kick off another tax filing season. Recently enacted legislation, obviously a whole host of guidance that I know your group has been very active in working on, both TCJA and otherwise. So yeah, I guess what's kind of your take, or kind of the big things to be focusing on with the upcoming tax season in mind as it relates to guidance or new provisions?
I think some of the international rules are still being looked at and understood. There were some changes with the BEAT rules that came out in December, and I think we're much better off than we were a year ago. There's more certainty from that perspective than a year ago, but maybe we have half the guidance out. The IRS tends to focus on the guidance that impacts the most taxpayers first, and it's not the only calculation that goes into their decision-making process, but it is one of them. And there is a lot more guidance out from the TCJA perspective than a year ago. That Chief Counsel's office was hard at work for the whole year, and a lot more guidance is out. And so CPAs and other professionals and taxpayers have more of the information they need to make decisions. So I think it should be an easier filing season from that perspective. I just don't think everything is not there. We're not going to have the government shutdown we had a year ago. So I think things will start off on a better footing at the end of this month when filing season begins. So it should be better, but there's usually a flurry of activity from Chief Counsel at the end of the year, and there was a lot of guidance that came out that needs to be digested and understood on how it impacts CPAs clients.
Yeah, there absolutely was. There has been just sort of in general. I feel like it's been a busy time in the tax world, which not really complaining over here because I enjoy, kind of digesting and keeping up with all the changes. But man, is it a lot sometimes? And I do kind of get a sense, particularly from practitioners, of almost a sense of feeling overwhelmed. I don't know if that's something that you've heard as well from members or those that you're talking with.
Well, it's not a new conversation. That's been for several years.
Right.
Right. So the rate of change seems to accelerate and probably will never slow down. The question is how much more could be absorbed, possibly absorbed. You would think that you just couldn't take any more, and I think at some point something happens to change the status quo, and from that perspective. But right now, I don't see things slowing down.
Yeah, what are some of the initiatives that your team and some of the member resources are going to be working on this year as it relates to tax policy?
I would say the first thing, and it's something that I think would be very helpful for CPAs and continuing the conversation we just had, which relates to the Taxpayer First Act, which passed last summer. And one of the provisions in the Taxpayer First Act requires the IRS to issue a potential plan of reorganization. They have to issue that plan to Congress by the end of the fiscal year, so that by September 30th of this year. We've been hard at work on that because the IRS is likely to have their first draft of a reorganization plan in place, let's say by early February, because it will have to go through a lot of vetting within their organization before they submit it to Congress. We're in the process. We have been, including through December. We've been on a sort of a listening tour, if you will, where we're trying to lead other practitioner organizations in developing our thoughts to give to the IRS by the end of January, so that we have the best opportunity to have an impact on the IRS's thinking. In other words, we want them to know what we think before they have their first draft rather than after. And the mainstay of what we would like to see in their potential reorganization is the Practitioner Services Division, which is something that you and I have spoken about in the past. It would be a commissioner level organization at the same level as wage and investment or LB&I or exempt orgs and government entities, that type of level of organization, but it would focus on certain represented taxpayers. And we think that by including that in an reorganization, the IRS would be able to improve service levels to all taxpayers, not just represented taxpayers. So that's something that is a high priority for us. We had spoken about it for the last several years, and it's something that we're promoting now, hoping that it'll get into the IRS reorganization plans. Now, the commissioner has spoken about it publicly in a number of venues, and he seems favorably disposed to something like that. Although that doesn't mean it's a done deal, and far from it. There are a lot of voices that are going to go into making decisions. So, but the fact that he's spoken positively about it publicly is a good sign. We're pleased with that, but we're not relying on that as the final decision. Far from it. So that's a major effort for us right now. We have a meeting scheduled with stakeholder groups to come together to try to give a sort of a unified voice of recommendations to the IRS by the end of the month.
Yeah, are there other things that are kind of maybe on the horizon that are in the focus?
And I would say another area that is a heavy focus for us is the OECD effort looking at the digitalization of the economy and updating really what are 100-year-old rules for profit allocation and bringing them up to a digitalized world. And obviously, 100 years ago, allocating profits between jurisdictions was a much different calculation than it needs to be today. So we're pretty busy in that area. We wanted to play a leading role in commenting, and we submitted 6 comment letters to the OECD, the organization out of Paris that is leading an effort to drive towards a global consensus on refining those rules.
Yeah, that's been a very fascinating development to watch, and that's also kind of on a tighter deadline as well, right? If I'm not mistaken, in terms of
Right.
what the goals are and getting something agreed upon.
So I think that'll change a little bit. The OECD put out a program of work last May, and the program of work focused on 2 pillars in the hopes of gaining a global consensus by the end of 2020. I think that's going to be pretty hard to achieve. Those 2 pillars deal with the 2 major aspects of the work that has to be done. So pillar number 1 deals with developing a new profit allocation and nexus rules, and pillar number 2 deals with some kind of a global minimum tax. And they've put out public consultations in both areas, but the drafts of the rules that they have are fairly complicated, and they need more refinement and more decisions. So they didn't put out final ideas. They put out sort of temporary draft ideas and needed feedback so that they could further refine each of the proposals. So I think we'll be seeing further additional public consultations in both pillars. I think pillar number 2 will have a second one because it needs a lot more refinement right now. So I think the next public consultation will be a second one on pillar number 2. And I think we'll see that time frame moving out beyond 2020. I think also that the U.S. has generally supported the OECD effort, as does the AICPA, utilizing the OECD to try to drive towards a global consensus. Treasury believes in that. We do as well. But there was a letter about a month or so ago from Treasury Secretary Mnuchin where they expressed some concerns about what was going on. One of the pillars seemed to be moving away from utilizing the arm's length approach for developing some of the profit allocation rules, and Treasury supports keeping some of the arm's length rules in place, rules that have been around for a while, as part of the profit allocation calculation. And so there was some concern expressed in that letter. Just a personal opinion, and I think it's the administration signaling not that they're moving away from the OECD approach, but maybe trying to refine the thinking of it a little bit more publicly. In other words, if it were, the U.S. probably wouldn't support it as it's drafted, and since 80% of digital taxes would impact U.S. companies, there's a likelihood that the U.S. would not support it. U.S. Congress would have to support it and enact something anyway, and I don't think that would happen unless there were some changes to the way it's developing out. So bottom line is I think the end of 2020 is just not going to work, and I think it's going to play out at least into the middle of 2021.
It being an election year, I feel like again, being a presidential election, and there's been a lot of conversations around different tax proposals. And, well, yeah, tax has sort of been in the news a lot lately, I guess is what I'm trying to say. Any thoughts on that or how that'll impact your group at this stage in the game?
Well, we keep an eye on things, but we don't generally comment on presidential proposals. It really is just a lot of posturing in terms of what their proposals would be, but it's not serious from the perspective of what would a whole Congress be interested in. So we don't tend to comment on candidates' proposals from in the tax arena. And again, with the limited resources we have, we have to see where we can have the biggest impact. So we'll look at more at proposals that come out of Congress rather than statements from candidates. So you won't see us commenting on candidates' proposals. Playing a significant role in the guidance area is going to continue for us, and we spoke about that earlier in the conversation, that there's been a significant amount of guidance and a lot came out at the end of the year. But that will continue into 2020, TCJA related and other, and we'll continue to play a significant role in commenting on proposed regulations and other administrative issues that IRS deals with. So that is something that will continue for us. The implementation of the Taxpayer First Act, including the IRS reorganization. So that takes a lot of effort, a lot of time from our volunteers. So we'll be busy with a lot of that.
Maybe any other areas or other things on your mind that we haven't talked about yet that you think?
Well, yeah, I mentioned we'll go back to what we started with, extenders. I think there's going to be a necessity to go back and see what needs to be amended. And so there were a number of provisions that had expired at 12/31/17. Those 18 returns, 2018 returns, were filed in 2019. We're already past the extended due dates for those returns. And so I think it's going to be important for CPAs to, if they have any suspicion that some of those extenders impacted some of their clients, to go back and consider amending returns. Just sort of weighing the cost benefit and doing that analysis and making recommendations to their clients.
Yeah, no, that's a great point. And one I was actually going to ask your take on, because we always can get concerned about statute of limitations. So that's the ultimate clock here. But, in terms of time to do it, we are looking right down the pipeline at next tax season. So it kind of seems like we're in that nice window of time to do something about that here in the month of January.
Maybe now is a good time for CPAs to spend a few minutes sort of doing a triage for their clients before the next several weeks, before they start getting busy with filing season, to see, do I have any clients that had previously taken advantage of some of the provisions that have expired at 12/31/17. So, and to start considering amended returns. There's still time. I mean, they could do it over the summer as well, but you can do an initial triage and maybe notify clients that after this filing season, you get through the filing season, to have that conversation and have the CPAs make some recommendations to their clients. So statute is a ways off, but it'll come up quickly, and you need to make some decisions in that area.
That's it for now, but we'll keep up on and keep cutting through the static of these and other consistent developments out there in the tax world on the podcast. I'd like to thank Ed, Dan, and Lynn for stopping by to share their insights, and would like to invite you to check out the show notes of this episode, available at bkd.com/simplytax, to learn more about our great guests today and to get additional resources. I'd also really appreciate it if you would drop us an email at simplytax@bkd.com and leave us a rating and review at Apple Podcasts or wherever you get your podcasts, to let you know what you thought of the episode and the podcast. If you haven't already, I'd also really enjoy connecting with you on social media. You can find me out on Twitter, where I tweet about tax at Damien Martin CPA, on Instagram, where I post about my life at the intersection of tax and being a dad at TaxDad, on YouTube by subscribing to our Simply Tax YouTube channel, and out on LinkedIn. I'm Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.